Sam Stovall is joining, the chief investment strategist at CFRA Research. Sam, you got a great report that connects these two things that often go together: bear markets, recessions. I think the assumption by a million miles right now is that we'll get some kind of recessionary print, but technically that would mean 2 quarters of declining GDP. And well, we got some time for that to happen. So what does history tell us about what the stock market is saying?
Well, Oliver, first off, good to talk to you again. What the stock market basically says is you don't hunt for a recession and then extrapolate what might happen to the stock market. Usually it happens in reverse. The market tends to respond an average of about 8 months before the economy does. And what we find is that the market goes into a tailspin. We find then that once we fall into recession, that earnings tend to follow suit. CFRA analysts, as well as consensus estimates, are calling for the first 3 quarters of 2020 to show year-on-year declines in corporate profits. So not surprising that we will end up having the NBER later on tell us that we did slip into a recession, probably in the first quarter of this year.
So, Sam, what's the connection between that earnings recession that you're describing and the technical economic recession for GDP? Because in 2015-16, we got like 6 quarters, I believe it was, 5 or 6, of declining year-over-year earnings numbers, and we never technically ticked off a recession.
That's right. Good memory there. The reason was because analysts finally concluded, well, you know what? We can blame all of this on energy back in 2015, 2016. Take energy out of the equation, and earnings were up 7+%, whereas they leave them in and they were in negative territory. However, this time around, you're not just looking at one culprit. You're looking at a majority of the sectors in the S&P 500 expected to post year-on-year declines. So the real question is, okay, if we do end up falling into an economic recession, and 3 quarters of all earnings recessions have predicted economic recession since World War II, the question then is, what happens to corporate earnings? And history basically says that on average, we see a 10% decline in S&P 500 earnings during recessions, which would be pretty painful this time around.
So an average 8 months, the stock market leads the actual recession. Sam, how do you factor in the speed? Because the speed of the market has already generated a monstrous response through fiscal and monetary policy. So if we're looking at like this compressed time frame, is there a possibility here then that the consensus view is somehow gotten ahead of itself, even though these numbers are going to be terrible? For the last 2 quarters, it seems like we already, it lasted 2 weeks, the sell-off, before we got a massive, massive package to help.
Exactly. Well, actually, back in 1990, both the bear market started in the same month in which the economy fell into recession. So sometimes they do go hand in hand, but mainly the market tends to anticipate recessions. This time around, you're absolutely correct that when we hit the peak on February 19th, we then took only 22 calendar days to fall into the bear market mode of a minus 20% threshold. And if we find that the March 23rd low, which took off 34% from the S&P 500, ends up being the low for this bear market, it basically came at 1/3 the second shortest speed. So 33 calendar days versus 80+ calendar days in 1987. So yes, it shows that computers definitely have a place in market volatility in terms of the sell-offs. And also it could be implying that maybe there are too many people out there calling for a retest of the recent low that could then be undercut because maybe Mr. Market is going to try to embarrass the greatest number of people, myself included, who are saying that history says we should prepare for a retest.
Yeah, well said, Sam. There's a big debate about that going on right now, the retest or to not retest. I want to talk again, continue with some of the stuff that maybe is a little bit less than guesswork. I mean, it hasn't been in the past. From your experience, Sam, you've always done a great job estimating earnings, following those earnings as they come out. But how much does this now become guesswork as well? Because I've got a table from you looking at valuations next to potential earnings scenarios. Walk me through what you're looking at here. Where do the consensus views come in right now? Do we have any idea how much the S&P 500 earnings will drop?
Yes, well, right now, S&P Capital IQ consensus estimates are pointing to a 4% decline in 2020 estimates. But of course, that's down from an 8% gain forecasted earlier in the year. Looking back to World War II, on average, S&P 500 earnings have fallen 10% during recessions. So if that were the case this time around, that would bring us down to about $148 on the S&P 500 versus the $164 forecasted, or at least earned in 2019. Not only do earnings come down, but obviously, therefore, investor sentiment and multiples tend to come down, with the average PE being close to 12 times. So if history were to repeat and we ended up with a 10% decline in 2020 in earnings, we ended up with a 12 multiple, that would point to around 1770 on the S&P 500, or a bear market that rivaled what we saw in 2000 through 2002.
Interesting. All right. So this is forward valuations we're looking at. The scenario here that looks the loftiest is considering a 16 multiple. But again, this market's moving so quick. I just want to outline to our viewers who are following along on the table here the scenario for earnings and the price that you get. So either way, in like a very good case scenario, Sam, we're still looking pretty far off the highs that we got at 33.90.
That's right. We're off the highs right now, about down 34% through March 23rd. If history repeats, we have further to go. But at the same time, it would take us a while, I think, for us to get back to break even. No bull market in excess of 30% took fewer than 20 months to get back to break even.
Yeah. All right, Sam, appreciate it. Nice work for us here, walking through the details of a very fast-moving market, historical connections, 8 months on average. But this time we may not have to wait that long, Sam, but TBD. Appreciate the insight, appreciate the work as always. Sam Stovall, Chief Investment Strategist at CFRA.